Hello, everybody. Thank you for joining us today on the K Properties 1031 Exchange DST investment conference call. We'll begin with risks and disclosures. DST 1031 properties are only available to accredited investors, generally described as having a net worth of over $1 million exclusive of primary residence, and accredited entities only, generally described as entity owned entirely by accredited investors and or an entity with gross assets of greater than $5 million. If you're unsure if you are an accredited investor and or an accredited entity, please verify with your CPA or attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and or real estate. Such offers are only made through a private placement memorandum, PPM, which is solely available to accredited investors and accredited entities. Securities are offered through Finex Capital, member of FINRA SIPC. Finex Capital and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax or legal advisors for advice, guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trusts, DST properties, including, but not limited to, loss of the entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investors' situations and objectives vary, this information is not intended to indicate a suitability for any particular investor. Please speak with your CPA and or attorney to determine if an investment in real estate DST properties is suitable for your particular situation and or circumstances. Past performance is not indicative of future returns. Potential cash flow, returns, appreciation are not guaranteed and could be lower than anticipated. Thank you for listening in, and now I'd like to turn the call over to Matthew McFarland, Senior Vice President with K Properties and Investments. Go ahead, Matt.
Thank you very much, Eugene, for the introduction. And as always, thank you to our listeners. We really appreciate you tuning in to another episode of DST Essentials with K Properties. For those joining us for the very first time, this is a weekly recurring conversation that we have where typically myself or another team member will interview one of the other team members that make up the K Properties team, and we dive into specific topics, recurring themes, nuances to the DST investment process. This is one of many educational formats that we offer for investors to engage with, to learn more about the DST structure and the 1031 exchange process at large. So very excited to continue this series today. Before I introduce our guest, I want to give just a little bit of information about K Properties. K Properties is a national Delaware Statutory Trust investment firm. Our platform, www.kpi1031.com, provides access to the marketplace of DSTs. This includes DSTs from over 25 different DST sponsor companies, custom DSTs only available to K clients, as well as on occasion active DST secondary market listings. The K Properties team members collectively have over 130 years worth of real estate experience, are licensed in all 50 states, and have participated in excess of $30 billion worth of DST 1031 investments. Today, I am very excited to have Alex Madden on the call with me. Alex is a Senior Vice President that heads up the K Properties Boston office. Alex is both a leader and a specialist in the 1031 DST space and has a vast 1031 exchange transactional experience to date. Alex has helped K Properties participate in more than $15 billion worth of 1031 investments, totaling over 50 million square feet of multifamily manufactured housing, single tenant net lease industrial self-storage, and medical properties nationwide. Today we're going to be digging in and discussing the commercial real estate debt crisis. We'll explain more of what we mean by that in just a second. But specifically, we're going to uncover how it's affecting real estate across the country and the power of debt-free investing. So without further ado, Alex, welcome to the call, and thanks for being with us today.
Absolutely, Matt. It is always a pleasure to be here and kind of unpack some of these different, more nuanced aspects. I think it's worth noting, that we're not tax advisors, and we do not provide tax or legal advice. So always please consult your CPA and attorney with regards to your particular situation. But I think that the topic that we're going to talk about today is just really great. We've it's something that we've been seeing a lot in the headlines, and I think this may be helpful for a lot of our listeners here who are kind of wondering, what does this all mean? What's the effect of some of these interest rates, and just kind of how is that playing out in the real estate space? So I think it's definitely one worth talking through today, Matt.
Absolutely. Yeah, and I'm looking forward to getting into it in a little bit more detail with you. So maybe let's start with the obvious question of maybe having you unpack what we mean by the commercial real estate debt crisis that we're experiencing. Can you go into more detail on that?
Sure. Yeah, absolutely. And I think it bears noting that there's certainly some scare tactics going on in the wider real estate world. I think that we're not necessarily in the same debt crisis that we were at in say like the 2008 timeframe. And one of the big differences being, though in the great financial crisis it was generally very unsecured loans or poorly represented. Could have been no job, no income loans, zero down kind of a situation. And having lived through the pandemic here and the associated real estate boom, we all remember the stories of houses going all cash, $100,000 over asking price. And so the effect of something like that is that there's a lot more money in the dirt, so to speak, which makes it a little bit more difficult for investors to necessarily just go and default on a lot of these loans and walk away from these properties. And then also, we've got, there's been a lot more stringent lending requirements since the great financial crisis. So, again, there's not these, zero down loans where, we're necessarily going to see, massive, swaths of the real estate market just walking away and the banks are holding these properties. So I think it's a little bit different than back then. So that's kind of what it's not, or at least generally speaking. And then, talking about, okay, well then what is this crisis that people are kind of talking about? And there's a lot of spilled ink going on, in this subject. Well, the dynamic is this, Matt. It's where, over the last 10 years or so, a lot of loans were originated in a very low interest rate environment. And so, maybe an investor went out and got a mortgage, commercial mortgage, which unlike residential mortgages, commercial mortgages are typically 10 years or shorter. And so when we think about interest rates over the last 10 years or so, they were substantially lower than where they are right now. Maybe 2, 3, 4%. 4% would have been a pretty high interest rate even 3 years ago. So now we're looking at a lot of interest rates, in the 5, 6, 7, maybe even 8% range for these mortgages. So we've got this dynamic where investors went and purchased these commercial properties with very low interest rates, and now those loans are starting to come due. And they're looking to, okay, I'm going to go try and refinance this loan, and they're getting caught because maybe they had a 3% interest rate and now they're having to refi at a 7% interest rate. Well, the returns, the rental growth associated maybe from a commercial net lease type property hasn't grown enough to make that a profitable, continuation of the business where they might not be able to cover that debt service. And so a lot of different commercial type properties are now faced with a difficult decision of, are they going to refinance at a higher interest rate and take a bath on the returns perspective, or are they potentially going to sell, lower, maybe substantially lower than they had expected to. And then of course, there's always the terrible situation of, a potential foreclosure. And I think, hopefully for all of our sakes, the banks have done a good job of having recourse against people, for these loans, so that we're not, facing another kind of 2008 type time frame. But yeah, that's, in a broad sense, that's kind of what we're referring to. What I think a lot of the different forecasters and those kind of talking about this, I'm doing the air quotes here, but this debt crisis, what's going on, Matt?
Yeah, well, that's super helpful, Alex. I really appreciate the context and how you walked us through the last 10 years, because that's really the difficulty that we're seeing play out today is, many investors, and that could be, an individual investor, it can be a large institutional investor, they're seeing their debt come due, right? And there's really two options. One, sell the property, or two, look to refinance. And borrowing cost in certain cases could be triple what it was when they originated their loan. And there's all different types of loans too. I've talked to a number of investors recently who have structured floating rate or adjustable rate mortgages. Maybe there's a 3-year fixed interest rate structure into a 10-year balloon, where, originally they based a pro forma off of the assumption that the rates maybe would go up a little bit, but not nearly as much as we're, experiencing today. And all of this too, on the sales side, the interest rate environment, largely impacts the cap rate environment, right? I mean, to oversimplify it, you would expect the cap rates of commercial properties to expand or go up when you see interest rates, expand or move upward. We've seen, over the last 2 years, interest rates triple, and we are starting to see an impact on pricing, right? In certain asset classes more than others. I mean, we see in the headlines these large urban office properties that are getting hit the worst, all the way out to maybe your multifamily type properties have been, the most resilient from a pricing perspective, arguably. So it's all really important just to be aware of how those dynamics play out. And that is going to translate into how we approach the investment space, specifically with 1031 exchange investors into DSTs, which is what I wanted to ask as the next question, Alex. So given kind of the backdrop that you provided and what we're reading in the headlines, what we're experiencing, how does all this play into our investment strategy in today's environment?
Great question. And I think it the financial landscape is a very complex and intertwined one. And so even as we look at, what's going on with interest rates and maturing debt, I think I'll at least give a nod towards the fact that, there still is persistent inflation. And so, this is a factor that plays into the real estate market. And what I mean by that is that, even though those asset classes that you were just laying out, Matt, particularly apartments in the urban core, particularly office in the urban core, probably been hit the worst. But even, some of those other multifamily, where we've seen, some real movement on the cap rates, a lot of, what would typically be referred to as like your entry level pricing, either single family homes, duplexes, small apartment buildings, smaller commercial properties. By that, I mean like $5 million or below. These are all extremely competitive. And so for a lot of investors, who are thinking, oh, I'm going to go and get a single family home, and just kind of, go get into that. Those are, amazingly, all across the country, there's still a real hot market for those single family homes, for those, for some smaller type, commercial properties. So still very, very competitive. We haven't seen as much movement on cap rates, generally speaking, kind of in that kind of entry level, what I think a lot of our investors could probably go consider, doing by themselves. But what's really great about the DSTs is that, investors are able to access, potentially higher quality assets, and diversify across a lot of those assets. So in that, 20, 50, 100, $150 million space that a lot of these DSTs are in, I think, on like an apples to apples comparison, we have seen some more movement in those cap rates. And so, one of the nice things is that investors who are doing 1031 exchanges, maybe it's a good time to sell that single family rental, or maybe it's a good time to sell that, that commercial type property, and then go access a much larger property, maybe in a different geography, using the institutional buying power of some of our various sponsor partners here, and then end up, being more diversified. So I think, being able to step up into that next echelon of real estate, and there's just, frankly speaking, not that it's not competitive at that space, but it's less competitive than like the $5 million and below, if that makes sense.
Yeah, I think that's super helpful. And you're right. I mean, if you look at it from an affordability perspective, there are a lot of potential buyers that can access that price point type real estate deal, right? And what's been interesting to see is we have seen more of an institutional presence in these smaller price point deals. I mean, think about, this built for rent concept, for example. Institutions, over the last several decades have pretty much stayed out of the single family home ownership space. It was, more difficult to manage that than a high density, Class A apartment type building. But we have seen institutions start to get involved in these smaller price point type deals. Self-storage is another great example too, right? Self-storage is becoming more and more institutionalized, and what that has created is much more competition and has kept pricing, pretty high, despite everything that we're talking about. I think you bring up, a really interesting point with respect to the ability to step up and diversify, and I think that kind of plays into the general strategy with DSTs, or one of the main benefits that we see is the ability in an uncertain environment to spread your equity across multiple different independently operated passive real estate opportunities to kind of hedge your bet a little bit, right? If you're doing an exchange and selling, a commercial property for $2.5 million, in a traditional sense, most investors are taking that $2.5 million and purchasing another property, right? So one property for one property. But with the DSTs, most of our investors on average are purchasing into 4 different DSTs from, or more, or maybe a little less, from one individual sale. So I think the diversification can be really powerful in today's environment. Alex, I want to maybe hear as we kind of close here in the next 5 minutes or so, maybe if you can expand a little bit on the debt side of the equation, specifically within the DST space. How are you approaching, leveraged DSTs versus debt-free DSTs with investors in today's environment?
Sure. Yeah, I think, one part that's really related, and just kind of want to follow up on what you were saying, I think that with the maturing debt of a lot of these commercial type properties, there's an opportunity to come in and create DSTs. And this is kind of something that we're seeing more sponsors doing. But able to get potentially higher cash on cash returns for some of these, because maybe the sellers have maturing debt. And so, there's a lot of dynamics that kind of go into how a DST is created. And obviously, nothing is guaranteed from rent and that sort of thing. But we are kind of starting to see some more flexibility in, because of that maturing debt, there's the potential for these DST sponsor companies to go ahead and create some DSTs that are looking like they might be, even more attractive than some of the things that we've seen, in the not too distant past. But kind of coming back to really address your question, Matt. It's kind of this case in point. I was having a conversation with an investor just yesterday. We were doing a Zoom call, and we were kind of talking through this dynamic, and they were thinking about, well, maybe I should take on a little bit of debt. But they were also asking me about, why does such and such a DST, why are they getting it at such a great price? And I kind of explained this whole debt crisis situation to them. And then they said, oh gosh, well, I don't want to take on debt, because what if interest rates are even higher when it's sold in the future? And I think that was spot on, because, if you take on debt in an exchange right now, you're going to need to replace that in a future exchange, most likely. And so, we don't know where interest rates are going to be at. But I think we're not financial planners, but a general financial planning consideration is not taking on debt as you get later and later into life. And that equal or greater value requirement for the 1031 exchange oftentimes means that if you take on debt, you'll need to replace it in your next exchange. And so I think wherever possible, I know I'm talking with clients, Matt, I'm sure you are as well, about remaining debt free, if at all possible. I also don't necessarily see a whole lot of benefit to it. I mean, you used to take on debt at a low interest rate because you were getting, a little bit of a bump. You would make some additional potential returns on the spread between the interest rate and the cap rate. You would maybe get a little bit of a bump there. But because interest rates are so high right now, we're not really seeing that. It doesn't seem like there's a great advantage to taking on debt from a cash on cash kind of return potential there. And so at times it can even be the reverse. It can have a drag on the potential cash on cash returns. So I think wherever possible, I'm recommending to mitigate risk, go debt free, diversify, and generally just avoid taking on that that potential albatross for future exchanges.
Yeah, I think that was super helpful. And yeah, I'm having similar conversations with investors, and I think the reality for a lot of our DST investors, or someone who would be attracted to this as an option, someone who's looking to go from active to passive management, usually a DST investor has very little to no financing, because they've owned their properties for 20, 30, 40 years, and they've worked really hard to pay down the balance of the loan over that period of time. So to willingly go back into a leverage position and have the debt follow them for the rest of their life doesn't always make sense. In certain cases it can, and with this we're having a general dialogue, but for each investor's situation it is different, and there could be situations where it does make sense to take on a little bit of debt. But I think, what it comes down to for me is, in the conversations that I'm having with investors, is now is the time to be defensive, right? There is some uncertainty brewing. There has been uncertainty brewing for seems like a very long time. But if we can position a portfolio as defensively as possible, with principal preservation as that kind of paramount objective, staying debt-free or limiting debt exposure is really the best way to do that. And the great thing is, in today's environment, because of the interest rates and because of everything that we've talked about, there actually are many more debt-free DST offerings available to investors. So now is a really great time to consider debt-free DST investing compared to years past, where maybe it was the opposite of the environment that we're seeing today. So that's really what I wanted to mention. And the last thing I'll add is, it's really important to be careful too with the types of properties that we're looking at as it relates to financing as well. We're not going to go into all the details, on this conversation, but I think also being really careful with where that debt is allocated in an investor's portfolio is a conversation that we're having, with different investors. Alex, is there anything you would want to add, or any closing thoughts here as we wrap up the conversation today?
Sure. No, I think there's a lot more to be said about this, and I think you hit the nail on the head, Matt, when you said that each investor situation is different. And I think we have a lot of tools in the toolkit. Having participated as a firm in over 30 billion of this kind of real estate, we've got a lot of experience. We've really seen a lot of different 1031 exchange transactions. I'm not going to say we've seen it all, but it feels like it sometimes. And so if you have a question, please reach out to your K Properties representative. We've got a phenomenal team approach here, and we are accessible. And please, if you're trying to accomplish something, talk it over with your K Properties representative, because we've really gone through it and can help you, hopefully accomplish what you want to, and really hone it into your specific situation.
Yeah, I think that's great, Alex. And I want to thank you for your time today and all the great information you shared with us. I really enjoy hosting this conversation with you specifically. So thank you very much for your time. And to all of our listeners, thank you for joining us. As mentioned at the top of the call, we do host this call live every Friday at 11 o'clock Pacific or 2 o'clock Eastern. So please do join us next week on DST Essentials with K Properties. With that, I wish everyone a wonderful rest of your Friday and a phenomenal weekend ahead. And we look forward to speaking to each and every one of you very soon. Thanks, everyone, and take care.
Make sure to visit kpi1031.com, and you'll be able to log in for free access to our listings of 1031 Exchange Delaware Statutory Trust properties. You'll also be able to get several other different resources available to our investors on 1031 exchanges at kpi1031.com. You'll get a free book on 1031 DST properties that will send you a free subscription to the 1031 DST Digest magazine. It has all kinds of case studies, tenant overviews, educational resources, and articles in the 1031 DST Digest. And you'll get access to free 1031 exchange educational conference calls that we host every week with our investors on various topics regarding 1031 exchanges, asset classes, financing, debt-free DSTs, zero coupon offerings, different strategies to use when thinking about a 1031 exchange into DST properties. Our team is here to help. We've done a lot of these Delaware Statutory Trust transactions and have helped thousands of investors nationwide complete 1031 exchanges into Delaware Statutory Trust properties. We're here for you. Just reach out to us anytime at kpi1031.com. And as always, feel free to call or email me anytime.